Welcome back, everyone, to Vox Markets Live. My name is Paul Hill, and I'm delighted again to be able to speak to accomplished UK small and mid-cap fund managers, Christopher and Nick Mills of Harwood Capital. So a massive welcome, gents.
Morning,
Good
Paul.
morning, everybody.
Thanks for having us back on.
No, I'm absolutely delighted. We certainly need your help. I mean, we've had 6 months of really big news since we last spoke, not least the sort of the fire bombs with the Trump trade tariffs. We've had sticky inflation, high interest rates, obviously the ongoing wars in the Middle East and Ukraine, plus more recently, actually, the depreciating dollar. So lots to think about. But putting all that together, putting all that together, gents, what's your sort of like your view of equities, your outlook going forward for the rest of the year and into 2026?
Okay, well, we kind of still see quite a lot of headwinds, to be honest with you. One of the big things that I've talked about in the past is the government's theoretical wish to build 1.5 million houses. We're nowhere even close. And, we'd be lucky if we did 180,000 this year. It's almost inconceivable they could even get to a run rate of 1.5 million in the period. And that's before we're dealing with a whole bunch of other little goodies that are about to hit the housing industry. So if you just look at stuff that's coming at the housing industry, you've got a plot tax, which is £3,000 a plot for greenfield, £1,500 for a brownfield. Then we go into real absurdity. They're talking about making the landfill tax the same across all stuff. So at the moment, a house builder, he pays £4 a tonne to put into landfill. That could go to as much as £120 a tonne by 2030. And that would increase the price of a house, we estimate, by as much as £10,000. And it really will impact kind of all houses, obviously bigger ones a bit more, but then there is Miliband's ideas, heat pumps, etc. That could put another £9,000 on the cost of a normal house. And then there's building safety, which is a sort of 4% tax arriving, courtesy of, I think, Mr. Gove. And that could put another sort of, say, £10,000 on the cost of a house. So the basic cost of a house could go up 15%, let's say Gleeson home, for kind of exactly the same thing. And then if you put building inflation the same as wage inflation, they're just about to become more unaffordable. And this is a key plank of government policy. And therefore, it's perhaps not surprising you're seeing downgrades in the housing sector, building materials sector, and everything around it. The initial optimism of the government boosting that, they talk about wishing to do it, but consumers are going to have less money to do it with. The housing associations still haven't got any money. They might be getting some. There's no concept of help to buy of any sort. So that's a key plank of government policy that isn't going to happen, and which is a major part of the British economy.
Just on that one then,
sorry, we're also seeing... Okay, we're also seeing, a number of profit warnings. I think I saw somewhere that the level of profit warnings is sort of back to, well, if you exclude, the COVID profit warnings, you're back to sort of 10-year records of profit warnings at the moment. And we all know that domestic UK economy is not great. Now, obviously, the FTSE 100 seems to be benefiting from, they seem to be able to control costs a bit better, and obviously they don't have the same NIC headwinds as the smaller companies in the UK because they're more global. So they're doing well, but actually in the sort of companies we're investing in, there are genuine headwinds, and companies aren't finding it so easy to pass the costs on.
Just on one of those, then, we talked about the sort of the housing market. We've got Ben Sharman. He's asking about a long-term house builder that I know you own, which is MJ Gleeson, and you mentioned it does affordable homes in the north, east, and also into the Midlands. it's trading at roughly around about, I don't know, 25, 30% discount to net tangible assets. A lot of that bad news you talked about is already obviously in the price. How do you see the outlook for sort of MJ Gleeson going forward?
Well, we should be ideally placed because our houses are definitely more affordable than in the south. We're within the reach of somebody who's working in the local authority or emergency services, plus his wife perhaps doing some boxes at Lidl. So we are affordable, but my point is that all these government policies are going to make us less affordable, but that's true for the whole industry anyway. I think the other point to make with Gleeson is, yes, we're trading at a, say, 23% discount to tangible book. But I think it'd be fair to say there is significant value in our strategic land business. So as to enterprise value, the discount's probably closer to 30%. So yes, the stock is definitely cheap, but we have the same problems that everybody else in the housing industry has. One of the problems we don't have to any particular degree, which is a sort of a separate issue, is around cladding, where there are suggestions that a number of the major house builders will have to increase their cladding reserves. But then, we still have other problems, which everybody else has got, is that they're now suggesting that water companies should become involved in the planning process. And presumably that's another way of saying that water companies will probably ask us to do the connections to the houses, which will be another increase in the price of an ordinary house. And then you've got a further problem, is that the local authorities may now be given the right to demand how quickly a site is developed. And God knows what that means, because they could easily say it's within 2 years, and that would make a lot of sites uneconomic. So in theory, Gleeson is very well placed, but it has all the headwinds that all the house builders have, with the notable exception of major cladding problems.
Mm-hmm. So you think that obviously the government's initiatives, because just here around where I live, we've got literally thousands of new houses which are being proposed and they're going through planning permission. But frankly, if the costs are too high when they're constructed and they can't make a profit on them, are they going to get made? Are they going to get built, these houses?
Well, some of them will, and some of these things will take time to come in. So the landfill tax thing will edge in over the next 5 years. Miliband's thing, sometimes that gets delayed a bit, but the building safety thing, that's arriving for sure, and all these other regulatory matters are like the water authorities are arriving for sure. Water companies, sorry. Okay, good. Let's, in the same sort of sector, we've got another question from Nigel Seddon. He's asking about Hargreaves Services, which has a land development division up in the northeast. I think it's putting properties and wind turbines on it. The other two divisions, I think, are contracting and building construction, helping the HS2. And I think it's also got a position with Sizewell C. And then it has a sort of like a steel trading commodities business in Germany. A lot of moving parts. In fact, really, you're perfect stock for special situations. The shares have done very well, even in a poor backdrop. How are you seeing this one going forward?
Yeah, the shares, I think, we're at all-time highs. If you don't go back too far when it was a coal trading business, then they certainly are. I think you'd have to go back 15 years, and it's around £10. So the land bank portfolio was old coal mines that have been converted into development sites, and then we sell them to Persimmon and Bellway and the likes of that. Blindwells is the big site, which was purchased in 2013 and has required quite a lot of capital invested in it, and is on paper worth £3.50 to £4 a share, just that division. And we'd hope to realise that and start bringing some cash in over the next few years, because we do believe the development capital has now been spent. And we've certainly waited long enough. And then the other bits you mentioned were the renewable land size. It has been flagged earlier in the year that we're looking to sell at least the first tranche of that. In terms of estimated value, it's difficult to say, but it's certainly above where we hold it in book, which is essentially nothing. And we have flagged that it's likely to get sold by the end of this year. So that's still a hope and an agenda. I would flag to your listeners, Paul, that there has been an update on trading, but the actual trading statement will come out this week. So I really encourage people to read them. It's always very thorough. I think the really interesting bit that you mentioned, and perhaps a more positive outlook on the UK, is the mega trend at the moment is this government infrastructure spend. So we all understand HS2, Sizewell C coming online. We're already generating some revenue in our earthworks division for that. And if we look at the pipeline for earthworks, we've got the third runway at Heathrow. Now, I'm not saying these are contracted, but they go up for tender in the next few years. There's Heathrow third runway. That could be about £1 billion of earthworks. There's the Luton Airport expansion. There's the Lower Thames crossing. And then there's about 3 reservoirs that we're looking to build in the UK. A huge one in Abingdon. I mean, Abingdon would be about £1 billion of earthworks alone, and the other 2 are probably 500 million each. So if you look at that, I mean, just in earthworks, that is north of £3 billion of earthworks in this country in infrastructure projects, of which Hargreaves Services would certainly hope to have a position in. And actually, if we look at just the third runway, we did the contracting for Terminal 5. So there is a relationship there, albeit with, going back quite a ways. But it's such a big pizza that just, a little bit of it would be great. And then Germany, the broader industrials business, we also think is worth about £4 a share. So you've got £4 minimum, by the way, when I say this, to be conservative. £4 of land, £4 in industrials, and about £1.50, £2 in Germany. Again, these are rough estimates, but I know you've had other investors on who've talked about £9.60, £10. Certainly, we'd agree with that as a base case. I still think there's very good upside on the shares. You're exposed to these mega trends, and there's a healthy dividend paying you 5%. And to remind your listeners, this is essentially in breakup, but piece by piece. So our objective is sell off an asset like the renewable tranche, and then we'd look to return capital to shareholders as and when. And I do think we're hoping to do a capital markets day at some point later in the year, which would be a good one to attend, and that would help understand how this capital is returned to shareholders. But it's still a company we're very, very keen on. We haven't sold a share, and I sit on the board. There's a long-standing board member. There's a very high quality management team, and the CEO owns 8.5% of it. So he's about as aligned as it gets these days.
Well, I'll tip my hat to you guys, because I know you've owned it for a long period and you've been banging the table in terms of the hidden value and that, and is exactly sort of like coming to fruition. Now, another one in the sort of the hidden value there, Christopher, that I know you basically highlighted to investors, I think in December 2023, as your sort of like a thing that people should look for 2024, and as duly delivered, is Pinewood Technologies, which is the software business that helps motor dealers do all of their sales and management of their inventory, and it's separated from Pendragon, I think it was, a long time ago. Anyway, it seems to have worked perfectly. I can't believe how well the shares. But what's your latest view? Given they're not now optically that cheap, they're trading at 7.5 times EV sales.
Yes, I think that certainly, the stock, if you adjust for the stock curve, basically they did a 20-for-1 reverse split. So we kind of started at about 150p, and it's up to about 482 now over that period. Market cap's about 520 million, and it's not cheap today, but we still are remaining holders. They've done an awful lot since we first invested. They've now bought out the US joint venture. They've added new dealerships. So the original story was 2027 and 27 million of EBITDA. They're now looking probably to get into sort of 33 to 34 million of EBITDA by 2027. And ultimately, the US joint venture should add, just from the Lynthia contracts, about 20 million. So you're looking at somewhere in the region of 53 million, but they capitalize about 5 million of R&D. So let's say in US terms, just keep the number easy, 50 million. And it's our view that at some stage they will look to put this company onto the US market, whereas, you know, multiples of EV/EBITDA are very much higher for SaaS-based software businesses, particularly for a business growing as fast as this one. So very difficult to say it's a screaming buy now, because it's not, but it's certainly not something we're selling. And we have a price target of in 2027, 28 of somewhere between £7 and £8 a share.
Wow. Yeah, I mean, I know one of its big competitors, I think, is trading at about 15 times out in the States, or 15, 20, and I can't remember what it was, but I remember looking at it last time. Just on moving to another one, we've got Tony. He's asking about another one that the Harwood put a spotlight on in about 2020. Asthma Diagnostics business may ring a bell here. That's gone from strength to strength, returned a lot of cash. NIOX. I don't know if you could give us an update on that one, because again, it's knocked the ball out the park over 5 years in returns of the share performance, but also dividends and return of capital.
No, I think NIOX has continued to perform extremely well, and you would have seen an update earlier in the year that showed significant growth year on year. So it has, I think, been the gift that keeps on giving. Obviously, we should probably discuss the fact there was a bid earlier in the year from Keensight Capital. They are a private equity firm that approached us and had done a fair amount of work on it. Obviously, the deal broke. It was the week of Trump behaving rather unusually around tariffs. I think it was a situation where everyone got a bit nervous, particularly on the private equity side. So the good thing is it hasn't been distracting for management. We talk about the sort of EBITDA growth in this. I know that a few of your listeners don't like the term EBITDA because they prefer to talk about cash flow. But I think it's kind of one and the same in NIOX, because we have about I don't know how many left, but about 400 or 500 million of tax loss carry forwards. There's no debt, very, very healthy balance sheets. So it basically all falls through to free cash, and we're generating north of £1.5 million of cash a month. In terms of the M&A agenda, we're not looking to go and spend a ton of money on a new business, so that money just is gradually returned to shareholders. I think that the levers of growth are obviously rollout in the US. We've got some distribution partners there. We've flagged the NIOX Pro, which would be an updated model, and the at-home testing is still another lever we can pull. That's still a bit early stage, but it's something later in the year. And obviously, we do have plenty of capital that we can use for any design or development there. But in the meantime, returning capital to shareholders is still the preferred route. And I think it's there were questions around is tariffs now a huge problem for us. Management have stated publicly that it's actually de minimis and they haven't seen any impact. I know that's not been true for some peers and other businesses that had hoped to absorb some of that and have failed to, but with NIOX it hasn't been an issue.
Good. Okay, well, we've got Jim asking about it's basically prisoner tagging electronic sort of surveillance software and hardware company, big technology. Now, I know you can't talk about what's been happening in terms of the management and the potential litigation, but something about the sort of the business, because I know it's now got the old CEO from NIOX, who's now NIOX, Ian Johnson. Which obviously, with his track record, there must be something there that is interesting. So, don't you got just a few words about the underlying business?
Okay, well, the underlying business is a fundamentally very good business. Ian has been in there for a couple of months now, and he's very excited about the growth prospects. They've had to reorganize the management, I think in a good way, taking it from a entrepreneurial run business now to a more institutionally organized business, if that's a good way of putting it. The company has nearly 100 million in cash. Market cap today is about 278 million,
yeah.
And the EBITDA is running at about 28 million pounds, so it's not expensive. You really can't talk about this company without addressing the litigation issues. It's now a proven fact that the former CEO lied about the true ownership of the business, with a very significant holding being held in the Murray Trust, beneficiaries Sarah Murray and Rowena Murray. And that raises issues. There's around a whole bunch of lawsuits, which I really can't comment on.
Yeah. Okay, fine. All right. So it's basically a wait and see, that one. If there's this value, if we can unlock value if the litigation is hopefully sorted in due course.
Yeah, and I think Ian's very pleased with the general business, right? It's high quality prison tagging. We've read in the press about overcrowded prisons. You know, they do need to resolve this problem, and this is a best-in-class product. Where they've previously lost on contracts is the competitor is just winning on price. So what's the point in having lower price for something that doesn't work, particularly when you've got potentially violent criminals on the street with, you know, untagged. So
yeah, some of the other products, believe it or not, you could just cut off your ankles. So they lose where the prisoners are.
Yeah.
So this is the best product on the marketplace. You know, we expect that they're going to win other contracts in various other countries around the world. But obviously these things take time. But the problem with litigation is it can drag on an awfully long time, as I've experienced in the past.
Yeah, I know the feeling. Okay, we've got another question from Andy2205. He's asking about another stock you highlighted in January, I think, Christopher, which was Spire Healthcare. It's the UK's biggest private health hospital operator, about 40 facilities, I think, and also some sort of health centres. It struggled actually absorbing some of the NI and passing that on to the NHS, but has gone through, according to the press, quite a big, tough round in efficiency savings. It's made, unfortunately, some people redundant, I think, and the shares have rebounded to around about the same level when you talked about it, actually, in January. What's your latest on this one, Christopher?
Well, I think just to sort of remind people of the story, the property is in the books for 1.4 billion. Market cap today is 900 million. If you adjust for the rent, there's about 130 million of EBITDA in the, let's say, operating company, and there's about 300 million of debt. You've seen a whole bunch of transactions in the space, particularly the bidding war for Assura, which kind of validates the thesis that this is a very cheap property stock, if nothing else. And as you said, they're doing a number of things to improve productivity. If you believe the brokers' forecasts, the operating business should be materially more profitable than it is today. So, you know, something should happen here sooner or later, because it's just fundamentally very, very, very undervalued.
Yeah.
Relative to the tangible value of the business.
Is there still an Indian interest in there at all? We don't know yet.
The answer is we don't know.
Okay.
I mean, if there is, he should have got on with it by now, I'd have thought.
Okay. All right. Let's keep in the sort of healthcare sector. We've got consumer healthcare products company Venture Life that Simon is asking about, because it was a new addition, I think, into the Oryx portfolio. They did a bit of a deal of the century, selling off their manufacturing business to an Italian company for about, I think it was 62 million euros, which gave them like 41p per share of cash, which they're reinvesting in their brands. How do you see this one going forward? Because it just has really sort of transformed the business, that deal.
Okay, so they've got about 36 million in cash now, net cash. They're selling off some small little businesses that they expect to get 4 million for. So that would take you to 40. and they believe that the remaining, what they call the growth businesses, will do about 8 million of EBITDA. If you just put those on the same multiple, it's a 10 multiple. You get to 120 million, and you get to private market value of about 90p a share. So, in line with our thesis of investing in companies that trade at significant discounts to private market value, we've added materially to our position over the last few months.
Yeah, good. Yeah, no, I mean it's done very well indeed. Okay, another one we've got. I know we've talked about before, industrials area. We've got Avingtrans, which basically does blast-proof doors for HS2 and also goes into defence. It's got a big exposure into nuclear, which is life extension, and also new build and decommissioning with secure box security boxes. Plus, it sells really quite high performance HVAC equipment into data centers. So lots of moving parts, and it's got that fledgling medical. Bit of a sum of the parts. What's your latest on Avingtrans?
Yeah, I was going to say the same, Paul. I think in line with Hargreaves Services, you've got a company that's sitting in these mega trends. There's the nuclear exposure, cooling systems for data centers. When you want to buy into where our money is being sensibly spent on, there are companies that are really exposed to this. I think where some investors get a bit confused on valuation is they start looking at a P or a multiple. And as you say, this is a sum of the parts valuation. It's invest and exit, and it's a very high quality management team. So if you look at the register, I think most people have just backed the management team for a very long time. It's been a long-term holding, and they've done very well at executing. I think within the AES portfolio, I mean, if you took just Harwood Tyler, which they've flirted with the idea of selling for a few years now, we think that's worth in excess of £100 million, which I think the market cap today is about 135, 140. And then the other assets sitting in there, Booth and Normandy, are seriously good assets as well. And on top of that, you get the medical, which, okay, yes, it's a bit early stage, and it's perhaps contributing negative value to the business, but actually it's got enormous upside. And if you talk to management, they're very, very positive and excited about it, and that could deliver fundamental returns. But if you ignore that completely, you're still getting significant, another 50, 60, 70% on the share price just from what sits in engineered services. So we're very, very positive on it. I don't know if it was...
Yeah, I think that's broadly fair. I think the trouble is, because the medical side's been A, loss-making, and B, cash consumptive, people have sort of lost the plot as to the real value that sits in this business. They still believe the medical business could easily be worth £3, £4, £5 a share. And clearly you're getting it for absolutely nothing. So it makes no sense.
Yeah. In the end, that engineering business, I know their normal sort of modus operandi has been to sell off after having turned around and invested in the company and improved it. What's your sort of latest on sort of like whether they maybe should buy and build rather than buy, build, and then exit in the engineering? Because you do need it's quite a tight portfolio of secular growth themes: the nuclear, the data centers, defense. It seems they're good growth areas.
I think the issue is that the strategy is to basically take a company, massively improve it, like Harwood Tyler, and kind of max out where it can go, and then try and do it all over again. So we don't see them changing the strategy of doing exits and returning capital to shareholders when it's appropriate. And I remember that we very much part of it. If Harwood Tyler was to be sold, you could expect to get a very significant return of capital to shareholders.
Okay, but I think, Paul, to your point, there's something like Harwood Tyler that's growing very nicely. It would never be sold for a song. That's where you trust the management team. They would understand the growth potential in the business, and I seriously doubt they would just go, let's divest this and get a bit of cash. They'd want a proper price for it.
Yeah. Okay, good. Let's turn back to healthcare. We've got Simon Rowan. He's asking about a company that issued a trading update today. I know we've talked about a lot, EKF Diagnostics, does point-of-care diagnostics for hematology and diabetes. I think the hematology is doing very well. There's sort of the growth areas, you know, iron testing, etc. What was your latest on this one? Because there is a bit on the, they've still got a bit to do on the, I think it's the fermentation, and they've got, is it the diabetes side with remote real-time diagnostic monitors and stuff. So anyway, what's your latest on EKF?
Well, the company's doing actually really well at the moment. Obviously, it's got a headwind because we've got a lot of assets in, it's a lot of earnings in US dollars, which obviously is not helped. But the company's come out and basically said it's comfortable with this year's forecasts. Cash by the market cap's about 120 million. The cash by the end of the year should be about 20 million. And if you look at brokers' forecasts, that over the next couple of years could easily grow to 40 million pounds. The company has a program to buy in shares, although I can't say it's been particularly successful so far. But you know, with free cash of about £800,000 a month, there's absolutely no reason why, you know, a good slug of that shouldn't go towards buying back shares as and when they're available, which I think puts a really good underpin on the stock. If you look at next year's forecast, you know, people are coming up with sort of 14+ million, and you know, you'd probably say 1.5 million of public company expenses. So you're looking at something trading 6.5 times. I mean, it's just crazy, silly cheap. Hence, that's why the shares are being bought back. People should not be disturbed by the fact that Harwood it has to sell when shares are bought back, because otherwise we go over 30%, we'd have to bid for the whole company, which obviously we can't do, or nobody would accept 27p anyway. So we get kind of caught there. So we're holding our holding at 29.9% effectively. But yes, we're very optimistic. And you know, the enzyme business, which has been slow, there's now signs that they are, you know, we could actually win some reasonable contracts over the next couple of years. Yeah. And that's a huge opportunity because the plant there is very underutilized and enzyme margins are very high.
Yeah. Is there any exposure to the real-time glucose sugar monitoring, those devices from Dexcom and from Medtronic, in terms of the diabetes testing side?
We don't believe so, but there's no question the diabetes testing side is the slowest growth part of the business. BHP, which basically is testing for, if you basically go into a coma from diabetes, there's a risk of having ketone acidosis, and that is, you know, the best test in the world for determining whether you've got that. The hemoglobin business is growing very rapidly indeed, and one of the problems there is that we've kind of run out of capacity of the monitors, so that's being built up over the second half, and we're going to expand that. And remember, you know, these are point-of-care tests, so you're doing hundreds of thousands of tests with relatively high margins. So it's a very, very sticky business. And
okay,
I mean, I hate to say it, but wars tend to be quite good for the business too, because people become anemic because they're underfed.
Yeah. Yeah, no, my wife uses your devices, those iron testers, every time she goes to give a donation to the blood banks and stuff like that. So it's great. We've got a couple of people asking about Videndum. Now, I know that's not yours, so I'm sorry, guys. We're going to have to move on from that one. But we've got one from Ben Sharman. He's asking about another one, which is a realizing value, NCC, which has got two divisions. It's got the S code division, which sort of is a secure data lock for software for businesses, very cash generative, not high growth, but a real cash cow. And then we've got the cybersecurity consultancy business. Both actually are being speculated they're actually on the block by press. Anyway, how do you see this one for realizing value for shareholders?
Okay, so the answer is, if you look at NCC, after the sale of that small business, they've got effectively no debt at the moment, a market cap of about 470 million. The S-code business actually isn't as bad as you think, because new countries are starting to mandate that their financial services industries use that technology. So the business actually recently has been actually growing a bit faster than people think. Our estimates that they're up to about 32 million of EBITDA now. And we would think it'd be very disappointing if they didn't get somewhere between 10 to 11 times EBITDA for that. It is a global world leader in what it does. So that would take you to say nearly 340 million. There's about 20 million of EBITDA sitting in the cyber business. And given all the cyber attacks around the world at the moment, and not least of all in our country, you'd expect this to start to grow a bit faster than it has in the past. So in our minds, we think this company is worth at least 200p a share on a breakup. And the fact of the matter is, I think it's actually been publicly confirmed all the businesses for sale at the moment.
Yeah, okay.
And that's one of the reasons you saw a bit of a jump in the share price the other day.
Yeah.
But obviously, the ESCO business which has been on the block for some time, I think now, critical to realizing that value.
Yeah. Yeah. No, it's got lots of visibility, hasn't it, in terms of sort of cash going forward. Okay, good. Just moving sectors. We've got Ben Sharman. He's asking about River Global B shares, which is it was basically part of the AssetCo business, the fund manager. And I think it was split out. I know you've talked about it before into the River Global asset management business, and then a River Global B shares, which are the Parmenion 30% stake, which I think is a data IT service platform for IFAs and for investments and stuff with that 30%. How do you see the River Global B shares?
Okay, well, I think the first point is that the business is actually doing really well.
Yeah.
And most recently, it won back the Ascot Lloyd account, which was one of their I think it was their biggest client when they lost it. So the core business is doing well, generating lots of cash, very well managed. AssetCo has publicly said that they believe their stake is worth between 75 million and 90 million pounds, which would be somewhere between 50 and 60 pence per share. In our minds, we're very comfortable with something in the middle of that, 55 pence per share. And before we went into the closed period, which we're just out of now, you'll have seen Harwood increasing its stake in the AssetCo B share. We believe a transaction will happen within the next couple of years. It certainly suits, we believe, Preservation Capital, who's the largest shareholder. It aligns with holding period for them is sort of 5 to 6 years, and so we're actually very excited about this one. And it's pretty illiquid is the problem.
Yeah.
But I don't see a lot of downside, and particularly as there's sort of two levels of debt. There's the bank debt, which I think is about 50 million, and then there's the shareholder debt. And the shareholder debt, about 30 million is attributable to the B shares, or about 20 pence per share.
Yeah.
So your equity value is pretty well underpinned, because that would value the rest of it only at about 90 million pounds, and it's worth way more than that.
Yeah. Okay. And is basically would be the Preservation Capital who would be the buyers, probably? Is it?
No, they would be the sellers.
Oh, the sellers of the whole lot. Yeah, okay, gotcha.
Okay, so it's kind of a joint venture. If you do it, and these are approximate numbers, we actually had a bit more, but they have about 50%. We've got about 25%. The management's got about 25%. It's not quite like that. I think we've got about 26.25%, but it's just easy if you just keep it in round numbers like that.
Okay, good. Well, let's move to we've got basically a food distributor into sort of like convenience stores and also food service. Kitwave, been through a few trials and tribulations of late. I think it was listed about 5 years ago on the market. It's struggled a bit to absorb some of the NI, and also it seems as though some of its food service destinations, particularly in the southwest, have been hit by the hot weather or lack of consumer activity. I think it bought a big business called Creed about 2 years ago or 18. Anyway, how do you see Kitwave going forward? It's as I say, it's going through a bit of a downside at the moment.
Look, I think starting point, I think the reaction to the update was particularly harsh, but I think that happened for two reasons, which they flagged, but later on that they probably could have been on top of. One, obviously the NIC, they said they could absorb it, they failed to. It probably would have been prudent to have done some provisions around that, because you just don't know what it's going to be. And then two, obviously around the Southwest facility, that looks like it's going to be more expensive and it's going to take a lot longer to complete. Having done a few of those relocations before in restructurings, they always take longer and they're always more expensive. So I don't think it's management fault for that. And people do forget that these moves involve relocating people, uncertainty around keeping your job, morale is damaged, you've got new people coming in. It all takes a bit longer than you'd hoped, and we see it all over the place. So I think what they had was an issue with flagging what was likely inevitable. And had they said that earlier on, the share price is not going to go from whatever it was, £3.30 to £2.30 in a day, because this is a fundamentally good business. The management team I have a lot of faith in. I think they are top-notch management team. They've been very, very good on their acquisitions, and I think they will continue to do good acquisitions. And it's a nice, there's not a huge amount of competition for the space they sit in. So I think they can continue to grow the top line. And at some point, it becomes a very attractive business for perhaps a larger player. In the short term, I think they're going to have a few more problems around the facility. Obviously disappointing to see. I think it was the average spend was down and volumes were roughly flat. Now we might see a little bit more of that. Obviously, Millsy spoke about housing and consumer spend. That could be a negative impact. So I think. Yes, is it going to be a bit choppy going forward for sure? But is this price completely unreasonable for the quality of the business? Absolutely. And I mean, we looked to pick up some more shares, on the back of this news, because I thought this is quite exemplary of what's happening in UK markets, right, Paul? You outperform, you have profit upgrades, and you get a 2 or 3% bump to your share price. You miscommunicate and have a little ding, and you lose 30% of your share price.
Right. No.
It does.
I think it's also worth pointing out that we originally had 5 million shares in this.
4 million.
4 million, sorry. We sold 2/3 of the position at substantially higher than this price.
Yeah.
So
no, we've done very well. I mean, we've been in since IPO, Paul. So I think it was north of £4. We let some go. We've got about 1.5 million left from 4 million. So it has been a very good position for us. It's not a typical Harwood stock because it's buy and build, and we tend to go more in the opposite direction. But still have total faith in this team and happy holders, and would look to add.
Yeah, you're right. You're right. I mean, the valuation is less than 9.5 times PE and pays a 4.5% dividend yield. So it's definitely not expensive. What sort of like pricing power has it got? That would be the sort of the key question. I mean, I know it does that sort of like the milk round type, sort of like root density is where it really sort of like, just gets a lot of benefits of economies of scale. But sort of like in terms of pushing through prices.
I think they've got a little bit, and they might try and be in line with inflation. I've always looked at it more on their efficiencies, both for delivery and beating their peers. Right, they do have a very good onboard system with their fleet. They are very proactive about implementing AI into their systems, where they can cut out unnecessary labour and make everything more efficient. I think they've got very forward-looking management teams. So, I think of it more on the cost side and preserving price rather than trying to round through incremental. Okay,
good. Right, we've got just moving up to software again.
Yes, we were a bit surprised because the hot weather usually they get a nice bump on ice cream, and
exactly.
So we were kind of expecting it to go the other way, but
I've had exactly the same experience. Okay, we've got Amanda. She's asking about a Tribal Group, which basically does the SaaS software for all the universities in the UK, and i.e. student planning, both onboarding students, all their courses and stuff going through the student, going through the university, and then obviously handling all the alumni. And then it does also EdTech services. I know you talked about this last time, Christopher. There was a bit of a sort of like a shindig between a company that wanted to acquire them, a trade buyer, about 74p, but there was a blocking shareholder, Genzibar, I think, and he was going through a personal situation with a divorce, I believe. Anyway, how do you see Tribal? It hasn't really moved actually since we've talked about it for the last 12 months, I think.
No, I think the answer is that the Genzibar situation, or the acrimony of that divorce, has certainly not mitigated itself in the last 6 months. Tribal is very much in a transition year because their admissions product is now entering the market. My understanding so far, that has done very well, in fact better than they expected. So you're looking, and on top of it, they've now resolved the problems with the contract in Singapore. And so where are we today? The debt is very little, a few million, like 3 million. The EBITDA for the current year is estimated to be about 15 million, which is a little down on last year because of a number of legacy contracts ran off. And obviously they have the NI problem as well. And then we're expecting growth to resume next year. And more importantly, the amount of capitalized R&D is falling through the floor. So that the cash generation in the business and the free cash generation should rise very rapidly. So you've got a SaaS-based software business, 100 million market cap, but 1.5 times recurring revenues, and 7 times EBITDA. I mean, it's completely the wrong price.
Yes, it's absolutely frankly nuts.
And I think the real issue is how do we get around the Zanzibar problem, because they are, not a constructive shareholder. They have a bad relationship with the management team. And the way we understand it is if the husband wins, he would buy the whole business. If the wife wins, she'd sell it. But at the moment, you're stuck in the middle of the two of them. And, it's pretty illiquid as well to add to the problems. So, it kind of is where it is. But the quality of the business is getting better. And, that we had a good conversation with management the other day where they gave us a path to achieving, EBITDA of, over 20 million pounds within 3 years, and possibly even higher than that, albeit going forward from that, they'd have to start winning new business, which is quite hard to win. So they were talking about, 20 million of EBITDA off their existing clients being achievable over a 2 to 3 year period, in which case the whole thing's just potty.
Yeah, no, I mean, as a multiple of sales for a software company with high recurring revenue streams, I've never seen anything quite so cheap. But I fail to be surprised on stuff on AIM because it definitely keeps.
Well, then it's only on AIM would you be wondering what a husband and wife's divorce proceedings are going to do.
Yeah, exactly. That's the only catalyst for the shop at the start. That is tragic, isn't it? Okay, we've got a number of people asking about industrial fasteners business, Trifast. I know we've talked about this one. Have you got your latest views on this one, Nick? I know you talked about it last time.
Well, Trifast, I've been on the board for a bit over 1.5 years now. And look, I think the really critical thing and the way to think about this business, just as an investment, is look at the improvements that Trifast have made year over year. You've taken the margin up from 5% to about 6.7%. They flagged that there's a journey towards 10% and that they can get there with steady improvements. They've consolidated the revenue base to get rid of loss-making contracts. Management are doing an absolutely stunning job. So if you look at the year over year, now look at the share price you put on the screen, right? It's flat down. So if I'm an investor, I want to go, okay, hold on a second. And it's a bit Jim Slatery, but here's a business that has made significant strides and no one cares, because Trifast has been around since the 70s. Everyone knows that name. And I had this with Hargreaves Services. I mean, when I joined the board, I'd go, guys, are you looking at Hargreaves Services? And they go, oh, isn't that the coal trading business? I went, no, it was a coal trading business, very different today. And it took a while for people to kind of update their views on the company. I think it's so similar here with Trifast. People will go, oh, well, you know, fasteners, automotive sector, which it does have, you know, 39–40% of its exposure to. But that is baked into the price. And if we can get this to a 10% margin business, I mean, the back of the fag packet is 1 times EV sales, right? So you've got 220 million, let's call it, of sales, and you've got 17–18 million of net debt. You know, that's the other thing, right? Leverage has come down significantly to kind of 1 times. And management compensated at 140p if you look at the LTIP structure, right? That's the kind of big payout. So the CEO has put a lot of his own money into this business from his salary, which is something that is always a green flag, as we know. He's very financially aligned to it. And the shares are currently trading at 72p. So I think it's one that people need to revisit, look at what improvements have been made, listen to some of what the management is saying, and understand this story again, because this, I think, is one of the best value situations on the market. We've increased our stake from when I started from 5.5% to 15%, and I sit on the board. We're not doing that for fun. Because I can't. The share price is still where it was a year ago. It's that simple. Now, look, I think there's a lot of consolidating still to do. There's still plenty of work in this business to get it really operating, and but you know, gold star to the management team. They are doing everything in their power to drive this forward. We are diversifying the revenue base. You'll look at smart infrastructure again. That when we're discussing Hargreaves and Avingtrans, that is in sexy areas like you know, data centers and HVAC and lighting systems. It's still small. It's about 16% of the top line, but that will slowly increase. And it also has the specialist manufacturing, specialist engineering. We can actually offer solutions that a lot of our competitors can't do. So customers come to us and say, look, we've got a problem with this. Can you fix that? Can you engineer that? And we can turn that around very, very quickly. I think in terms of pricing, we can protect our prices, because historically, the one thing this company's done very, very well is on time in full. And if you look at the inventory, it's quite high compared to our peers. So that, again, is something that the management team have been working on. How can we make this more efficient? Because the trapped cash in there is in the tens of millions. So as we get better understanding, implement this data transformation system, transformation system, we're going to have far slicker operations, and that'll unlock a lot of cash. I think one day, you know, people are going to wake up, look at this, and go, "What? You know, how am I not in this?" Vanilla business, but you know, it's here to. I'm very, very excited about this one.
Yeah. Well, I do highlight.
If you buy something as the same as last year, and it's a significantly better business, it's not a hard sell.
Yeah. Well, also, I do highlight to investors, Nick was on the board of Crestchick, another industrial company, for about 2 or 3 years before it was bought out at 4 times the price when he joined. So there was a bit of magic going on there.
I was going to say, it's NIOX, Hargreaves Services, Crestchick, the Nick Mills Ned ETF is
done rather well there. Yeah.
Trifast is the one that hasn't moved yet. So
okay. Go for the 4 strike. Okay, we've got a slightly bigger company. We've got Tate Lyle, which is obviously known for all of its food ingredients. I think it was sweeteners, and then it bought a really big business last year for about 1.8 billion. I think it was I can't remember what the business was in the States, but basically it was in mouthfeel apparently. What sort of interested you to Tate Lyle? Because it's an unusual sort of situation to a certain extent.
Okay, so this is something we had in North Atlantic Smaller Companies Trust, obviously, rather than Oryx to be way too big for Oryx. We actually have been in Tate & Lyle a number of times. Typically, we've been buying the stock at £5, and the first time we did it, we sold it at 7 and a bit. And then we went back in the Trump crash at 5, sold at 6, started buying it back again at 5.25, and it's about 5.50 today. The logic behind it is really, really simple. If you look at all the big food ingredients, specialty food ingredients companies in the world, they trade at very much higher multiples. Now, mouthfeel, ironically, is probably one of the possibly one of the fastest growing areas that's going to happen, because as you get all this interest in health, you're going to put less salt and less fat in. And those are both big additives to taste. So mouthfeel is all to do with taste, and Tate Lyle is the global market leader in this. It's also a global market leader in sucrose, i.e. stuff that goes into Diet Coke, which is a little healthier than aspartame for you. So if you actually look at it on the fundamentals, the thing is trading at 7.6 times this year's EBITDA. That is expected to fall as synergies come through from the acquisition to 5.7 times by 2027. Earnings per share expected to go up sort of 40% over that period, and the dividend to rise to nearly a 5% yield. It's also worth noting, and that as you can see that little spike where the stock went up to nearly 8 recently. That was as there was takeover rumors from US private equity. So if you go back and look at this company, 15 years ago, the stock price has probably done absolutely nothing. The business is a very much better business today, and it's not that big. It's for a private equity group, it's a couple of billion. So in our view, it's just a sitting duck.
Yeah. Okay, good. Let's move on. We've got a question from Jim. He's asking about Paypoint in the portfolio, which is basically an aggregation, I think, of a number of companies. It's got an e-commerce delivery, and also got the cash machines in convenience stores and a website and stuff. I think the business has done pretty well, actually. How do you see this one going forward?
Well, this has been a good investment for us, because we originally got in because what they call Love to Shop they took over, and we were shareholders in that. It's called Appreciate. We meet with the management frequently, who are very open, and they are going to achieve their target of 100 million of EBITDA. They're now talking of achieving a target of 125 million of EBITDA within the next 3 years, and we think that's eminently achievable. Now, that's being driven by fast growth areas. So 2 things particularly excite us is, as you all know, all these banks are closing down their branches. And their joint venture with Lloyds has the potential to become very profitable over the next few years. They've got some more software services which they're introducing, and the real excitement is around the parcel delivery, parcel business, which again is very profitable. And as you see the number of post offices starting to close down, people are going to have to put their parcels somewhere, and they believe that the relationship they have with Royal Mail could develop very materially over the next few years. So this is a business with very high EBITDA margins, nearly 50%, generating lots of free cash. They're buying back shares sort of almost every day, and they're committing to buy back even more shares over the next 3 years. You're getting a decent dividend yield of about 5.3%. And at our purchase price, it's nearly 9 or 10. So it's something that we've got very high confidence in the management, and ultimately they have a big stake in the business themselves. And I wouldn't be surprised if this company got sold when the CEO decides to retire.
Right. Yeah. Okay. Good. One final question. I know we're hitting towards the hour. We've got Steve Waters asking about Animalcare, which is basically the vet drug provider, and I think it sold some companies about the last 2 years, but also bought one out in Australia, Ranlab, I believe, which is a equine vet type pharmaceutical business. How do you see this one going forward?
Okay, so Animalcare, very simplistically, you've got just under 200 million market cap now.
Yeah.
We did sell a few when it hit £3, but actually we're now trying to buy them all back again because they missed by 2% and the stock went down. They required 7 or 8%. Basically, this company has a huge number of tailwinds because all these animals that were bought during COVID don't get ill immediately. They get ill 5 or 6 years later. So that part of the business should do really, really well. And businesses like this, it's trading, I think, about 12 times EBITDA, should be trading normally at around 15 times. 70% of their products are either exclusive to them or indeed their own product. But actually, this is not really why we own this business. It's the second biggest holding in Oryx at the moment. The real key to it is they're developing 2 new drugs. Now, Jenny Winter comes from AstraZeneca and she knows what she's doing. They're both related to pain management and peak sales in 2 areas. One's equine and one's companion animals. So peak sales for equine would be estimated to be around 40 million and 100 million for companion animals. If those both were to be successful, you'd be looking at profits of over £100 million, or about 4 to 5 times higher than current level of profitability. If they're not successful, the loss to the company probably wouldn't be more than 10 or 15 million. So it's a bet very much in your favor. We believe the equine product is doing well in trials, but remember, this is something that's not going to happen or become meaningful until near 2029, 2030. But clearly, as and when these things start getting approval, investors are going to look at starting the potential. And this stock, if things go according to plan, could easily treble or quadruple from here. But don't expect it to do it tomorrow. My point is, you're very well underpinned in the core business, which is nicely cash generative, in fact, very cash generative. You've got a reasonable little dividend. Jenny Winter is an outstandingly good CEO. She knows exactly what she's doing. When she went into this company, frankly, it was a total mess. She reduced the SKUs. She focused on developing her own products and getting exclusivity. And she would have liked to make an acquisition in Europe, but they're all too expensive. And that kind of says she's too cheap anyway. And if they don't work, look, I'm just speculating. My suspicion is that the 2 products didn't work. They'd probably sell the company within 3 or 4 years, and you get a nice uplift then anyway.
Well, it would remove all of the R&D they're spending, wouldn't it, from the cost line? So you'd see like huge uplift in cash generation from the existing portfolio. Well,
actually, the R&D for these products is not huge, and she's not capitalizing very much of it. So, no, it's when you're into companion animals, the cost of the R&D is relatively modest at the early stages. It's once you get sort of final trials, it ramps up a bit, but it's a fraction of the cost of human drugs.
Brilliant.
So we think it's a stunning story if you've got patience.
Brilliant. Okay, just before we finish, with a question I always ask all of our experts, and given your track record has been fabulous, we're definitely going to cover it, would be the sort of stocks to highlight as ideas for people to further research looking into 2026, because obviously, we're nearly at the end of 2025. After Pinewood, NIOX, Crestchick, and a bunch of others as well. What would be sort of the ones you'd sort of highlight that people should put the slide rule over?
Well, I think Trifast certainly is worth having a look at. And if they want a sort of more amusing corporate action one, Pebble Group is something we've just put a proper stake in. They might now, there's 2 things to know about this. We picked up shares at 33.5. It'd been a tiny shareholding for us, but BlackRock did a block trade. Management now are so aligned to break up this business or return value. They are doing a tender, I think it's about £6.5 million at 62
61, I thought.
61. So the shares are 52p at the moment. So you'll get 6.5, which is 5%. And then the LTIP structure basically begins at 82, 83p and scales up to 170p for management options. I think the only way they get there is to break this thing up. You've got a few activist shareholders in there. There's Primestone are in there, a couple of others. It's been a dog since IPO. I think they're all very motivated to get a result here. There's 2 businesses in there, so I think they can improve. They've got 2-3 years to do this, but the floor of what they need to achieve in order to earn any money is significantly above the current share price. I mean, it's 60% above the current share price, going up to 3x the share price, and obviously can be motivated and pushed in a direction to do it.
Yeah, I mean, our number is, I mean, again, if you have a bit of patience, because this is a 3-year program, you're looking at 110p, we think. It'd be a double over 3 years. The company's highly cash generative, and even after the tender, they'll still have about 10 million of cash. So, it's something we do like, and something we are buying at the moment.
That's the fun one, but Trifast is definitely mine.
Yeah, okay.
Concrete, that's what we do. That's what Hold are about.
Yeah. It does promotional products, doesn't it? The Pebble Group, I think, and there's got a bit of a platform business.
The brand edition came out of 4imprint a long time ago.
Yes.
And the Facilis, which is the platform, the high margin platform, which is something like 50% EBITDA margin, but lower revenue. And the theory was, if you sold one of the assets, you're getting the entire market cap and the other asset for free.
Yeah.
So, I mean, we still like Restore.
Okay. Yeah.
I think the private market value Restore is at least £4, could be as much as £4.50. Charles Skinner is doing a good job of turning it round. If he achieves his forecasts, you're looking at 30p a share within a couple of years' time of earnings. Reasonable dividend. Used to trade at nearly 20 times. You put a P on it of 15, and you get to £4.50. Very good recurring revenue business. 40 million of the EBITDA comes from boxes, and boxes collect cash and such.
Is there just on those boxes, just for investors' knowledge, is there a lifespan for these boxes? Because you have that 7-year data sort of archiving route, but are we talking these are sort of like coming out the NHS and legal things? They've got to hold for decades, never mind 7 years.
Yeah, they have to be held for years and years, and they increase the pricing by about sort of 3% a year, or inflation. I think the other point to make is to digitalize a box costs something like 150 quid, and to put it in storage, I think costs somewhere around 6 or 7. So
you keep it in storage.
You keep it in storage. They are optimizing their storage facilities, getting the rent down. And I think the best story is when Charles left the business, he had 7 people in the HQ. The new management managed to increase that to 57, and I think we're back down to 14 again. And he's been a big buyer of the stock personally. Last year he actually paid this price for shares. This year the share price went down. I think he was buying them again at £2.35.40, and they're back to about 2.70 and a bit now. And then my other one, which I don't normally do this, but I just like to point out, the attractions of Oryx.
Yes.
When we started managing Oryx, the adjusted NAV with the warrants was 90p. We're now over £18. The stock's, I think, 13.35. Yeah. But if you look at the underlying fundamental value of our NAV, all these companies we tell you about, that we basically look at the private market value of these companies, and then we say, what sort of discount are we buying it at? And you talk about a Pebble Group where we had to make 100%. When we did Pinewood, the story is we had to make 4 or 5 times. Hello.
I'm sorry, I think I've lost connection here. I don't know why. Let me just make sure it isn't me.
Hi, Paul.
Hi. Sorry about that. Did I freeze then?
Yes.
Yeah, you did.
Sorry about that.
So basically, we think that the outlook for Oryx is very good. And I've got to believe that because I bought my wife 70,000 shares recently.
That's definitely putting skin in the game. And I'd also highlight that Oryx was also recommended by Simon Thompson in the Investors Chronicle just recently as trading at an unwarranted discount to net tangible assets as well. So I think there's a lot of people who believe.
Well, it's a north of 30% discount for it. So I think, you know, for a very hands-on manager, we've got board seats on nearly 50% of the portfolio, at least in terms of names, certainly in terms of value. We've got 22 direct and indirect board seats. I think we offer something that's a little different to the traditional funds, and at a 30% discount. So,
well, but it's a discount on a discount, is my point.
Yeah.
Yes.
Because, you know, if you just simply take Spire and argue that sort of 35% discount, or any of the names we put out for you, they're all on discounts to what we believe the fundamental value of the business is. And that creates the opportunity.
Yeah, good.
And
that's a great point.
Oryx at one stage used to trade at full NAV.
That was back in 2020.
So, and, you know, we're very excited about our portfolio, as I think you've heard. Good.
Okay, well, thanks a lot, gents. That's excellent insights to all those companies, and certainly highlighting the value there in Oryx just at the end. Apologies for my internet cutting out. I don't know what happened then, but it doesn't happen. Luckily, it doesn't happen very often. So, very much thanks again, gents, and look forward in touching base in 6 months' time.
Thank you very much indeed.
Thanks a lot.
Brilliant. Bye-bye.